Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be here the week before, 1 week out before Thanksgiving, here in our studios in Florence, Kentucky. Ezra, welcome back to the United States.
Buongiorno.
Yeah. Had a nice long trip in Italy for work.
I did, yeah.
Very cool art grant, so I'm sure that was a good time.
It truly was something I'll never forget. It was life-changing.
I know. I'd love to go out there myself. Be even cooler to shoot a podcast from Venice. Like, that'd be pretty sweet.
It would. I'm sure there are other CFPs in Venice that would love a chance to just have a general collaborative discourse with someone like yourself.
Yeah, love that.
Maybe we could see about that.
I don't know if that's going to fit the budget next year or not, but down the road for sure.
Yeah.
But Thanksgiving, very much looking forward to that. One of my favorite holidays of the year. I make a amazing fried turkey, at least the last couple of years.
Nice.
Got a fresh bird this year from a local poultry farm. So we'll see how that goes.
Fresh bird, not to be confused with European slang for an attractive person.
Exactly. And I know that they got the movies are going to start rolling out. So favorite, I know we talk a lot of sports here. We got the Bengals playing tonight at Baltimore. Thursday night football.
That's on Prime, isn't it?
It is on Prime.
Cool.
So obviously I'll be watching that. So go Bengals. But favorite Thanksgiving Day movie? Do you have one? Because they play the Christmas Story, like, I think the whole day that day.
Yeah, which really kind of chaps my ass that we jump into Christmas on Thanksgiving. Honestly, I don't mind December 1st. I feel like that's fine.
Yeah.
Because people do that for Halloween. You start spooky season. It's like, that's cool. You want to start watching scary stuff or tell ghost stories. You know, I get it. This has nothing to do with Thanksgiving, but my favorite movie to watch on Thanksgiving Day is Empire Strikes Back.
That's a good one. I know, well, for me, first of all, when you come to my house, my wife's already got the full Christmas thing up, like lights, tree, ornaments, everything. It's already decorated for Christmas. And that was up right after Halloween.
Yeah, November 1st. It's like jingle bells. Well, I'm pretty fond of your wife, so I'm going to let that slide.
Of course.
I'm going to let that slide.
Of course. She's pretty awesome.
She's pretty great.
Yeah, I'm going to go. I like the Christmas Story, of course, but it is on Thanksgiving Day. So obviously Charlie Brown, the Thanksgiving, that's a good one.
I would say for like holiday themed movies.
Yeah.
That one's probably my favorite. There's also that, what's that? Isn't there that Vince Vaughn one where they go to the Thanksgiving?
I thought it was
the Christmas.
That's the Four Christmases.
Okay.
Yeah.
That's hilarious. So yeah, maybe just Charlie Brown. Yeah.
Well, we do. So Star Wars is usually on, I think. And then Lord of the Rings, I think, is also.
Those are cool.
Also a good one. So yeah, we'll be watching that stuff. Obviously it'll be football on too. It's Thanksgiving. So that'll be the thing.
That's it. And like Christmas Day for me too is also, I enjoy the marquee basketball matchups. You know, I usually have those on instead of the movies where.
No doubt.
You got to plow through Bad Santa.
Oh yeah.
You got to do all that stuff before you get there. You know, both the Grinches, the original and the Jim Carrey one, like those quite a bit. Elf gets a heavy play.
That's where I was going. House. Yeah, man. Love that one.
What else? Charlie Brown Christmas is pretty great. Yep. Rudolph, the stop action one from the late 70s.
Also awesome. Yeah, I'm going to introduce my younger daughter to that this year, I think.
Gremlins, I like that. That's a Christmas movie.
I won't let her see that one, but it freaked me out when I was a kid. Yeah.
The thing in that one is you're like, oh, cool. This is just a silly, ridiculous horror film that happens to take place at Christmas until the main character, Phoebe Gates, starts talking about how her dad dressed up as Santa one year and got stuck in the chimney and died. And they didn't know it until the following year. You're just like, wow. Hitting the punches on this Christmas movie. So.
Oh yeah. No, I'm excited. The holiday season is upon us. It's awesome. And we're getting closer to wrapping some things up business-wise here with customers, done a lot of quarterly reviews, almost done. It's been an amazing year. So we're going to talk about, how this all happened actually today. And for those who are joining the podcast for the first time, we have a lot of fun here. We usually kick off the show, a little bit of banter, some jokes, and but more importantly, the main reason why we do all this stuff is to not just inform you. The news is already letting you know all the things that we're going to be talking about here today, but it does a terrible job of giving you historical precedent about here's the other 25 times that we've been through said event, whatever the headline news is. and here's what actually happened with the markets over the next 3, 6, 9, 12 months. And that's what gives me control over my temperament, my emotions, because I see all the same headlines as everybody else. And the fact of the matter is, up until the last couple of weeks, it's been kind of 3 straight months of just steady, painful decline almost every day. And the reason for that is just all this terrible headline risk news. So the best way to control my emotions and my temperament is to actually look at what history had to say over similar events. And the reason why I think history is important, number one, Warren Buffett himself said that one thing we know for sure about human beings is they do not learn from history. So I want to learn the market history. And number two, the market is made up of human beings. So if they refuse to learn what the historical precedents are over similar events, that just gives us an edge here at Shepherd Wealth Management. If nobody else or very few market participants understand that, it's no wonder why people lose control of their emotions, get extremely fearful, and make poor decisions as it relates to things like investing in the markets. So that's the reason why we do this show. And I'm very excited to be talking about today's headline topic, which has been in the news here over the last, since Tuesday. So Tuesday, November 15th, we got the latest CPI report. We've been talking about this for freaking 2 years, I feel like, right? We've been talking about inflation and what the CPI readings are going to be since 2022. And we finally, I think, broke the back on inflation. Now, you're going to hear a lot of Fed speak today, right? So we're shooting this on Thursday. This is November 16th. It's around 11 o'clock in the morning here, Eastern Standard Time. And a lot of Fed officials are still going to talk a little tough because they want to keep their options open. They will get another inflation print in December, coming up here in December, as well as some jobs data. But the CPI news that we got on Tuesday was just absolutely fantastic, and something that we've been not just talking about for a long time, but accurately predicting the trajectory of inflation and what that means for the markets. And we used history to position people. I think all clients that we've spoken with have not only thanked us for doing this kind of show, sending out the newsletters, the Friday blogs that we do. We do a blog almost every single Friday, and it's about the same stuff. You know, here's what happened. Here's what history has to say about it. Here's how we're thinking about it relative to the headline news in history, and therefore here's how we're building your asset allocation. Here's how we're positioning things. And it's not just because of the performance, it's that extra level of service, which is a lot of service, right? Two podcasts a month, a monthly blog, Friday, a monthly newsletter, a Friday blog, and then we sit down with everybody every single quarter and go over things. But it's the historical precedent is why we've had the success. Our average customer, I looked at it today, is up 28.5%.
Oh, that's so awesome.
Which means some are doing way better than that.
Yeah.
Some maybe not quite as good depending on age and risk tolerance. But the market year to date is up like 17.5%. So absolutely beating the crap out of the S&P 500. And this is during a year, if we go back to January 23, we come out of all of 2022, the S&P is down 20%. The NASDAQ is down more than 30%. Everybody was calling for a recession. Sky was going to fall. Just the worst type of outcome is what everybody was expecting. There was actually a list of 20 of the biggest financial institutions giving their S&P projections, and all but 3 of them had the S&P above 4,000 to end this year. And here we are at 4,500 on the S&P 500. Nobody was calling anything close to that. A lot of people were expecting it to be below 4,000. I think the worst was like right around 3,200 or 3,000. So a lot of the biggest financial institutions get caught up in the headline news as well.
Yeah.
So here we are.
Believe in their own stuff. Yeah.
Exactly. They're all human beings, right? They can make mistakes.
Yeah.
But how do I avoid the mistakes, the big picture mistakes? Again, I think if you understand what history has to say about markets and knowing that the market is made up of other human beings, that gives us an edge here. So we talked about 2023 in January. When everybody else was saying the sky was going to fall, recession was happening, we were talking about this is a year for opportunity for double-digit gains. And that's exactly what we got on the market. You didn't even have to hire a person like me. You could have bought the market for free, right? And you'd be up 17.4% year to date. But you got a ton of people still sitting in cash. We're going to talk about that as well. So CPI, we got this on Tuesday.
Yeah.
The expectation for year over year CPI was 3.3%, came in at 3.2%, so lower is better. In September and August, CPI was at 3.7%. So that's quite a big big drop off from September and August, going from 3.7 down to 3.2. If you look at the CPI numbers month over month, so that was the headline number, 3.2. The month over month number was flat. The consensus expectation was positive 0.1. So again, lower is better. And if we looked at the CPI month over month number in September, it was 0.4. So that's a big drop off month over month. So why did that happen? Well, the one and obvious thing I think everybody understands is gasoline prices have fallen since the last month. It's actually fallen 5% month over month. So that was a big component of that. And in September, by the way, gasoline prices were positive 2.1%. So that 5% drop is a big reason why the CPI number was really good. But we also have some additional metrics here. Of course, CPI is just a headline. The Federal Reserve is very interested in core CPI. So core CPI, this removes food and energy prices. And I understand that that's something that everybody has to pay for. But the reason why the Fed removes it and likes to look at core is because their decisions with monetary policy cannot affect the price of food or the price of energy.
Yeah.
Right? That's all supply and demand. They have absolutely no impact from a monetary policy standpoint. So core CPI in October, expectation was 0.3% month over month. It came in at 0.2. Again, lower is better. And if we want to look at supercore, so supercore is actually the Fed's favorite measure. It removes not only food and energy, but also removes housing. And housing has actually been 70% of the CPI metric when it's been positive. Housing has effectively been the biggest reason for that. So if we look at supercore, it came in October, month over month at 0.2%. In September, it was 0.6. So that's a huge drop off in shelter. When we look at that supercore in October, year over year, it was expected to be 3.9. It came in at 3.7. But if you go back and look at that supercore number, month over month is 0.2. If you annualize that, right, just take 0.2, multiply it by 12, you're going to get 2.4% annualized supercore inflation. The Fed's shooting for 2%.
Yeah.
Dude, we're almost freaking there. And because of that, after this news came out on Tuesday this week at 8:30 in the morning, so again, the market doesn't even open up till 9:30, the odds of a December Fed rate hike in December fell to 0. It was as much as 30% last month, and now it is actually 0. And the market was up, and the pre-market on Tuesday was up about 2% before the market even opened up. So interest rates coming down, really good for stocks. The Fed is very likely done with their interest rate increases for this tightening cycle. And that's something that we've been counting on happening all year long. They've barely raised rates at all in 2023. A lot of people thought at one point in time, interest rates were going to go to like 6%.
I remember that.
Or maybe even higher. Like there was some
talking about that.
Pundits out there saying, well, the Fed might need to go to 7% to get inflation back down to 2%. So that is simply not the case. The Fed is winning the war on inflation. And to me, the geopolitical risk is always going to be there. Right. I know it's the headlines right now, but the truth of the matter is human beings, since we've been on this planet, we've been in conflict with each other somewhere on this planet. So you cannot diversify geopolitical risk away. It's always going to be there. And I understand that. But when it comes to things like interest rates and the Federal Reserve decisions, that's something that we can diversify ourselves around with. If we think inflation is going to go where a lot of people thought it was going to go, then I wouldn't have positioned the way that we positioned heavily in technology and industrials. Those are actually the last two places that you would want to be overweight if you thought inflation was in fact going to be an issue and we're going to go through a recession, which a lot of people were calling for this year. So again, looking at what history has to say is how we were able to accurately assess the risk of inflation. And in fact, the risk of inflation has been falling since the market bottomed in October of last year. So we've been in a bull market ever since then. I still don't know why there's over $5 trillion sitting in cash that has missed out on all of this market gain this year. But I think it has everything to do with people's emotions, getting the better of them. Like as we talked about, many, many times, the study of behavioral finance. It's just a study of how human beings make decisions with their money over stressful circumstances. And what we learned from this study, which, by the way, you can get a PhD in any major university, it just simply tells us that we feel losses twice as much as we feel good about making money. So if you are a nervous investor, that just makes you very human. Mm-hmm. what you need to understand though is your fear is probably driving a lot of your decisions. And if you can figure out a way on your own to remove emotions from your investment decision-making process, that would be the best thing for you. If you cannot do that, if you struggle with that, that's what we're here for. That's exactly what I'm here for. That's my job to do, is remove those emotions and put us in the best possible chance to achieve that individual's goals with as little volatility as we can possibly experience along the way. Now, getting back to this CPI stuff here, I thought this was pretty interesting as well. So we went through shelter was 70% of the increase in core prices over the past year. The October shelter index came in at 0.3%. I thought that was notable because in September, it was 0.6, so it fell by 50%, which is fantastic. That's the biggest slowdown since we've seen March earlier this year. And I thought that was definitely worth noting out. So what also helped the markets, not just this lower CPI print, but that forced the 10-year treasury and the 2-year treasury to start to fall. Mm-hmm. So at one point in time, we saw the 10-year above 5%. The 2-year was, bumping up against 5.1%. The 10-year fell 50 basis points. Literally fell 50 basis points after we got the CPI print, which is a staggering move for any part of the yield curve, but specifically on the 10-year, which again makes the odds of a Fed fund hike in December 0. Yeah. The 2-year went from basically 5%, and it fell 9.3 basis points to 4.8%. It's hanging out right around there right now as I'm delivering this information to everybody. The really cool part, and this is what we've been talking about with customers during our quarterly review, is the market really wasn't pricing in very high odds of a Fed cut in the first half of 2024 next year. Well, after we got the CPI news, the odds of a rate cut in May went from 30% up to 48%, nearly a 50% probability of a rate cut beginning in May. I actually think it's possible we could see a rate cut sooner than that. And this is the conversation I've been having with customers. And why do I feel that way? Well, again, we're going to get another CPI print coming up in December. We'll see what that looks like. If that continues the trajectory that we're going on right now, I think that I'm going to be probably very accurate in this assessment. But I still don't know. We still don't have the data. We'll get this in about the next 3 weeks, right? So the odds went up in May for a probability of a rate cut by 25 basis points. I think you might actually see it sooner than that. And I think you might see a cut bigger than that. And here's what I want people to consider. Very simply, the Fed has 2 jobs. One is maximum employment. And that box is checked. Unemployment rate still 3.9%. Historically, a 4% unemployment rate's really, really good. We would call that full employment.
Okay.
Right. So anything right around that 4% number or lower, that is full employment. So that box is checked. The other box the Fed is trying to check and make sure that they're got under control is inflation, or what they call price stability. Right. I believe, based on the numbers that we've seen and that we've already seen from all of 2023, is pointing to the Fed's target of 2% likely gets hit sometime in 2024. So if they go into 2024, and let's just assume that the December CPI data is favorable, just like the one that we just got now. It's continuing to fall. And unemployment hasn't spiked dramatically. Mm-hmm. Then they're going into 2024 with both mandates checked. And every day that they leave the Fed funds rate at 5.25% to 5.5%, that's extremely restrictive on an economy that's expected to have growing GDP, right? And that's also extremely restrictive on regional banks specifically, but the banking sector, the finance sector in general, is extremely restrictive. And there's no reason to be restrictive if we have full employment and inflation is on a glide path towards that 2% target sometime in 2024. It would make absolutely no sense to keep the Fed funds rate as high as it is. They're going to be forced to cut rates because their job has been completed. They've gotten both parts of the mandate done. And by the way, it is an election year. So for all of those that are rerunning for office, how nice would it be if they could say, hey, look, the Fed did a great job. They got inflation back under control. We have maximum employment still, and inflation's falling to the Fed's target. They're cutting interest rates. Yeah. That's going to be a really awesome message for everybody that's rerunning for any part of office in 2024. So I think that the odds of a probability of a rate cut should be baked into the market in the first half just like what the data is showing us here. But I actually think it could happen sooner in 2024 because of the reasons I just laid out. And it might actually be a bigger cut than 25 basis points. It could be something like a 50 basis point cut. So all of that being said, we don't have all the data. We're going to get that over the next 3 or 4 weeks. But if I'm right about that, the positioning is really what is going to mean a lot. So the other part that we're talking with clients about is not just the odds of a rate cut being increased based on the data that we've gotten. And my assumption is that that's going to continue in December, and the odds of a cut earlier in 24 will go up again.
Yeah.
But what do we do from a positioning standpoint? So we've been heavily overweight technology and industrials, and a little bit of energy, not so much now, but mostly technology and industrials all year long. So it would be prudent for us to rebalance at some point. Now, the dichotomy is with customers, if I'm right and we keep getting inflation to fall and the odds of a rate cut are continuing to go up, you really still love that positioning, the overweighting in technology as well as industrials. That's a good setup if I'm right about all this stuff. But we also understand, thanks to Warren Buffett, we want to be greedy when others are fearful. That's already happened this year.
Yeah.
I'm going to start to get a little fearful when others are getting greedy, and that's likely to happen from now to the end of the year. I think that the S&P target that we laid out mid-year was 4,900. I don't know if we'll see that. I think you might see something around 47 to 4,800, so not quite where we thought we might end the year up at. But we have to take this into consideration here because we do not want to be too greedy. We don't want to be so overweight that if something happens and the market falls for whatever the reason is, inflation comes back up or something else happens, we don't want to give away all of these gains back to the market. I mentioned our average customers up, big time versus the S&P. So I'm going to take those profits pretty soon here. I'm actually considering doing this right now. Maybe by the time I get done with this show, I'll completely make up my mind and I might actually start doing this week. But I'm thinking about taking somewhere in the 5 to 10% range of profits away from mostly tech, because that's our biggest overweighted area, and allocating that towards other areas of the market that are now starting to actually perform. So most of the year was all about what they call Magnificent 7 stocks, and all the other 493 stocks in the S&P really weren't participating that much. That is somewhat very true up until now. Because of all this inflation data that's been favorable and interest rates have been falling, the small cap index was up 5% on Tuesday, right? Wow. The overall indices were up 2%, that's a great day. Major averages up 2%, but the small caps were up 5%. They've been getting crushed for 2 straight years. I mean, it's some of the lowest numbers we've ever seen from a performance perspective in the history of small caps. And by the way, I did some research here. Bar chart today was showing some data that there's been more call buying on the Russell 2000. The IWM is the ticker symbol for the Russell 2000 ETF. At least that's one of them. There's been more call buying on the Russell 2000 than any other time in history. So when you're buying a call option, you're expecting the price to move up, right? That's how you would make money on that. So there's been more call buying there than ever. So what I'm thinking about doing right now, even though I might be right, we'll see, but I might be right about interest rates continuing to fall, inflation continuing to fall, which means stay overweight industrial, stay overweight tech. But if we take 5-10% profits from technology, which has been our biggest winner, NASDAQ up around 30+% year to date, I'm thinking of allocating those dollars to small caps. Even after that 5% move, there's still significant value there relative to where history would have to say. So I'm actually going to, at some point, move about 5 to 10% weighting into an area that we've tried to have exposure in this year in a small way, maybe 2 to 3% for customers, but it's just been a terrible place to be invested up until now. And it makes total sense because 30% of the Russell 2000 are regional banks. And we all know what happened with regional banks with earlier this year with the Silicon Valley Bank crisis. All of those stocks just absolutely crushed. Nobody wanted to touch them. And 30% of the Russell is those smaller banks. And if interest rates are going down and we get rate cuts, it's actually a really, really good thing for banks because rates will still be high enough for them to make money by lending to people that are looking for a mortgage or a car or whatever it is that they might be lending for. But that would be a really, really good thing for performance of regional banks. So that's what I'm thinking of doing right now. And if you've been a market participant, if you've been following the show all year long and you've made a lot of money in technology and industrials, you might want to consider doing the same thing. I don't know your age, goals, and risk tolerance, but it's good to be diversified when the other sectors of the market are participating, not just the biggest 7, tech names. And we haven't had a ton of exposure to that. And now I want to get into that for our customers, because although I do think tech and industrials will do just fine going into next year, assuming that we're correct about the December inflation prints that we're going to get. But you're also going to see other areas of the market start to participate, and we want to have exposure there as well. So that's something that we'll be doing for customers here very, very soon. Now, I know a lot of people were talking about for all of 2023, it was not just going to be this recession due to the Fed needing to increase rates to combat inflation, but it was all about earnings too. Everybody said the earnings for this year were going to suck. They were wrong again. Q3 earnings, we have 467 companies that have reported. That's 93% of the S&P 500. 82% of the companies that have reported so far have beat consensus expectations, and they beat those expectations by a median of 7%, which is fantastic. We're talking about very, very strong numbers here. And the good news is yesterday we continued to get news for inflation that is positive. The PPI, the Producer Price Index, the expectation for that was 0.1%. It came in at negative 0.5.
Wow.
So that's really good. So it's basically wholesale prices, right? That's generally a leading indicator for future CPI. So if you think about this, if we continue to get gasoline to fall, shelter is falling. We've seen that in the data here, finally showing up. That has the longest lag effect for those that are watching, by the way. That's why it's now finally starting to show up in the data. So that's going to continue. Used car prices have been falling. That's been another sticky part of inflation for the better part of this year. But now the wholesale prices have fallen substantially. And if you look at the core PPI number year over year, that's 2.9% today. That's before we get the additional data that we're going to get a month from now. So this is all a great setup for a year-end rally. Again, our price targets are pretty aggressive, that at least in a lot of people's eyes at the beginning of the year. But now that's not looking too bad for us right now. So I'm very, very much excited about that. And this isn't a pat on the back for us or a victory lap by any means, because what happened in the past has already happened. I'm already thinking about 2024. I'm going to have a ton to say about 2024 in December when we get to the podcast. And when we sit down with customers in January, we'll be talking all about it.
Yeah, I mean, we still got a month to go, but I am really looking forward to that end of the year roundup recap where we can see how the headlines did or did not come to fruition.
Yeah, and this has been a resilient market, man. I mean, if you sit back and kind of reminisce on the history of this year, coming in this year, I already mentioned how everybody was negative mindset about the market. Bearish positioning, but the S&P has had several chances to go full quote bear mode, right? We had a great start to the year in January and February, and then boom, we get Silicon Valley Bank going down among a couple other banks as well. Obviously the market sold off on that, but we had a nice little recovery. And then we had this Israeli-Hamas war. Market sold off on that. That was also right around a seasonal time that was very, very difficult. September or August and September, very, very difficult seasonal wise, because you don't have any data. There's no Fed speak. There's people taking vacations. You got lighter volumes in the markets during that period of time. And there's just nothing to worry about because you're not getting any macro data. You're not getting any earnings data. So the only thing that captures people's attention and sentiment on the market is whatever the headline news is. And the headline news was Fed speaker is ousted. The government may shut down on top of a war, 2 wars that are going on overseas. Yeah. So the market could have just collapsed several times this year, and it didn't, because of the fundamental fact that inflation is falling. Unemployment never spiked. Everybody that wanted a job had a job, and corporate America, the market, has some pretty savvy CEOs that have been through a lot of stuff. They've made a lot of good decisions as far as reducing unnecessary waste and spend. And their earnings have done nothing but prove to the upside that the market is extremely resilient. So I know you might sound like a smart person when you're being bearish on the market.
Yeah.
I don't know why people feel that way, because you're literally betting against the house. Like every January 1st, when you wake up as a market participant, there's about a 70% chance you're going to wake up at the end of the year with more money in your brokerage account just by participating in something like the S&P 500. So I think people think they have some sort of crystal ball or edge, and that's why people perceive them as smart when they're bearish about the market.
Yeah.
And there are points in time where it makes a lot of sense to be bearish on the market, but just looking at headline news as a reason to position yourself, I think that's just a terrible way to go about making investment decisions. Understand the news, but then go do some homework and do a little bit more due diligence on, oh yeah, there's been 17 other times that we've been through this, and here's what the outcome was 3, 6, 9, 12 months down the line. So I did want to share some performance updates with everybody as well. So we talked about the markets, but sector-wise, just here in the last month, the S&P 500 up 7%, industrials up 6.3%, but the big one, information technology, the tech sector, up 11.5%, consumer discretionary, which is going to have an Amazon weighting in that's 9.9%. I mean, we're just across the board, the stuff that should have, in most professional minds that were calling for a recession this year, they were expecting things like healthcare and utilities and stuff like that, materials to be the outperformers. Healthcare on a month is up 2% and utilities up 3%. I mean, you're talking about they're not even outperforming bonds.
Wow.
Right? So all those that are piled into money markets or short-term treasuries, yeah, that's been nice. It's been nice for the first time in 15 years that you've been able to park money in the most safe asset class on the planet, which would be treasuries, and actually get a return, right? That's been great. 5 to 5.5% has been awesome. But if you're sitting there in those 5% fixed income positions and the market's up 17.5, I mean, you tell me which one would you rather have? Yeah, you're getting more volatility by participating in something like the market as opposed to fixed income. But all of those that said, yeah, I'm going to do the T-bill and chill thing. I mean, you're chilling. You didn't have to worry about any of the volatility in the market, but you've also underperformed, by double digits, which is not a great way to go about compounding wealth.
No. And I feel like Shepherd Wealth Management is sitting on a absolute treasure trove of merchandising income with T-bill and chill.
I didn't coin that.
You can.
So that's been a theme. I mean, literally some of the biggest investors, billionaire investors, Jeffrey Gundlach is one of them. Ray Dalio from Double Line. I mean, these guys actually came up with that phrase, T-bill and chill.
Oh.
And it has been, don't get me wrong, one of the things that we're doing for customers right now is, again, anticipating that interest rates were going to fall due to the fact inflation's been falling and will continue to fall. If you do buy a long-term fixed income investment, whether it's a long-term corporate bond, long-term treasury, or doing something like what we're doing.
Yeah.
So what I don't like about buying, let's say, a 10-year corporate bond that's probably going to pay you 7% maybe, that's great. You've locked it in. And if rates fall, you're actually going to make money, the appreciation of the bond itself. That's also cool. But most people that buy those are not trying to trade them.
Right.
In general. There's some professional people that do that, but most people that buy something like a 10-year corporate bond are not going to trade. They're going to hold it till its maturity date. And that's cool. You're going to lock in 7% as long as that company is able to make those interest payments to you as a bondholder and they're in business. That's great. You get all your money back at the end of it and you collect 7% a year. Awesome. But I don't like locking people in that long. But what we can do is we can buy something like an ETF, the TLT, which is a iShares 20-year treasury. And if interest rates continue to fall, the value of those 20-year bonds is going up. So we're just trying to make money on the appreciation. We'll collect a little bit of interest along the way by having that position. But that's our way of going about having an allocation towards fixed income for certain clients, not all clients. Like myself, I'm not holding that position because I'm 36 years old. I got a long time to go before I'm going to retire. But for those that need a fixed income position, we'll buy that in their portfolio. And as rates continue to fall, as they have been, we're making money on the appreciation value of that ETF because those bonds are worth more as rates are coming down. And an ETF is a position that we can liquidate in 1/10 of a second on Schwab's platform. So we're not tied into a 20-year fixed income holding. So that's a smart way, in our view, to go about getting an allocation towards fixed income and taking advantage of the falling rate environment that we're likely going to continue to experience throughout the remainder of this year. Now, the last thing I wanted to finally highlight, I know we talked about, Warren Buffett quotes a lot here on the show, being greedy when others are fearful. This headline in the Wall Street Journal popped up. So Market Watch, which is a very well-known company that puts out a lot of data, a lot of news in the finance world. So this was today. This is November 16th, 9:35 in the morning. I'm looking at this, and the headline is this: this banking giant has been saying cash is king all year long. Now it advises a switch to stocks. So now you're going to start to see all these people piled in cash and money markets start to participate. I'm going to ride that wave.
Yeah.
For the rest of this year. I'm going to add some, like I said, to some small caps that we don't really have exposure to. But I'm going to ride this wave for the rest of this year, and it might continue into next year. But like I said, we're going to rebalance and take some profits away from the market to some degree, because I know everybody's about to get real greedy. And that's cool that they want to get greedy. They missed out on this, but that's just another way of looking at the next 6 months. Because who knows what's going to happen in election year. Election years historically are very good. And we'll have a ton to talk about next year as it relates to this. And we'll hopefully have some awesome Saturday Night Live skits. I don't know if that's been a thing just yet. I haven't caught up on that. I'm sure they've had to do something about these Republican debates.
Oh my God. Yeah.
It has to be, right? So that's for a different podcast. We'll talk about all the historical stuff with election years pretty soon. So we got a year-end wrap-up that'll happen sometime in December, right? Maybe early January, and then it's going to be full bore. Let's talk about the historical stuff that's happened during election years. I know, right? But
yeah,
here's the deal. Generally speaking, I'll give you a little teaser for everybody watching this show today, since we're talking about it. Generally, the market's good during an election year, regardless of the outcome. If you want to win, Republican, Democrat, markets are usually fine.
Yeah, doesn't it kind of start off good? It maybe takes a little dip, and then regardless of who win the election, it comes back up.
Right. It's
strong.
That first quarter is generally good because why? You're getting all the sales, right, that are happening right now between October and December. That's going to show up in corporate earnings announcements in Q1.
Yeah.
So usually, even during an election year, Q1's very good. It's the uncertain part, the next 2 quarters between, let's say, the end of March and early November, when we actually have the election results. So all that uncertainty is what causes markets to not be great during election year. But generally, after that uncertainty is removed, we know who's going to win the president's seat, and then the market's going to do well, for the remainder of a presidential year. And generally speaking, also the first year of a presidential, a new president, or if we get the Biden back in office. Doesn't matter. History would say the first year of after an election year is generally very good also. So we'll have a lot to say about the historical good and bad parts of election years for everybody, but still the focus is really going to remain around the path of inflation. And if it continues to fall, you're talking about rate cuts, and bigger rate cuts maybe happening sooner in 2024. And that's not priced into the market yet at all, right? We just talked about the first one being in May, and that's about a 50-50 chance right now. So if we can actually move that up in the year sometime before May, and that's not priced in the stocks, that's going to be a huge tailwind for equities coming out of what should be a really strong Q1 earnings announcement as well. So I'm very excited. I'm very bullish, if you can't tell, but I've been bullish all year long when most people haven't been. So I guess you could take it with a grain of salt, but I've also been right a lot too.
Yeah. I mean, like I said, I'm really looking forward to that end of the year recap. We might have to have some old fashions or something. If it's a celebration,
yeah,
I'm gonna make a spritz.
Yeah, we'll figure it out.
Yeah,
we'll do oysters with champagne, maybe. I'm not sure.
Ooh.
Although I might not be able to talk if we're doing that. So
yeah, that'd be great.
We'll come up with something, no doubt. But it's definitely going to be a celebration. I'm definitely expecting a year-end rally. I told you guys what I think the price targets, at least in my eyes, might look like, because we kind of peaked out this year around 4,600 on the S&P. And right now being at 4,500, that's not very far away to get to 4,600. We cross that line, let's say here in the next week or so, then I do believe that we'll finally see that 47 plus.
Because I think we were What was the high this year so far? Did you already say
It's
that?
a little over 4,600.
Okay, yeah, I was gonna say that's when we were hoping and thinking maybe that there was a chance for an all-time high.
Yeah, I actually was calling for 4,900 right around the time that the S&P peaked out at the end of July of this year, right at about a little over 4,600. And that's right around the time where I came out and said I thought that we might see 4,900 by the end of the year, which I don't think we'll see. That would be cool. I mean, I'm not going to root against it. But I do think that once we cross 4,600 in the S&P, I would be looking for something year-end wise between 4,700 and 4,800, based on the data that I'm looking at here. So I'm very excited. It's been a hell of a good year. Had a lot of fun doing these shows. We got a few more to do.
And I guess things could just go out like a fart in the wind in the next 5-6 weeks. But I really don't think that there's that much. It'd have to be something cataclysmic to come and really stamp at and just be like, no, hard landing, recession, here it is.
It'd have to be something dramatic.
Bend over, Abigail May. I don't think that's happening.
I don't think so
either.
either.
Not anyway.
Definitely not positioned that way. So definitely not counting on that at all. Of course, anything can happen in markets, but
I mean, you're still going to have people screaming loud. It's like with all the good news we've had all year, with the slow creep out of the danger that we were in. I mean, I know it still is there, but we're definitely way better off than where we started the year. Way better off.
17.5% better off at the moment.
Still have people screaming about the end of the economic world on TV. It just blows my mind. It's like, at what point do you look at the trajectory and the data and be like, okay, you know what? We can ease up on this fear mongering and maybe start to be happy and hopeful.
Yeah, I mean, there's still people that have been calling for bear market all year long that are on CNBC every single day. And they still don't agree that we're in a bull market. They still expect some sort of, fall in the S&P to 3,900. I know Mike Wilson at Morgan Stanley has been talking about 3,900 price target all year long. Like, at some point, if you're doing this professionally, you're going to lose your clients, right? If you can't humble up a little bit and say, you know what, probably had a wrong take.
Yeah.
And by the way, you only have a month and a half left to participate in what I believe will be a pretty significant year-end rally here. So the last thing I want to leave everybody with, a little bit of just basic financial planning, rebalancing. The asset allocation, we talk about it all year long. That explains 94% of the variability of performance in your portfolio over any period of time that you want to look at, short or long period of time. And that should be good news for those that are hearing this, because you are in control over that, or you've hired somebody like me to take control over that allocation. There's all kinds of stuff you cannot control. We can sit here between now and next Christmas talking about all the things you cannot control that will impact performance. But if 94% of the variability in your account comes from your allocation, good news, you have control over that. There's 11 sectors in the S&P. The best way to outperform is to figure out where you can overweight and underweight in the S&P sectors. Now, if you're right, like we have been, overweighting technology, overweighting industrials, that's how we've gotten that significant outperformance. We've almost ignored all the other sectors in the market, with the exception of energy this year. But that also is going to change. As I just mentioned, now you're starting to see the market breadth pick up. So you can control that allocation by rebalancing. And I'll give you a very simple example. Let's say you got 70% of your money in equities this year, and you're a client at Shepherd Wealth Management, you're up 30% on the equity portion of your account. Well, that's great. When you look at the end of the year, we're going to be high-fiving and hugging and talking about how awesome that was. But we don't want to go into next year, because now we have 30% more than we had in equities. So now we're up to maybe close to 80% or so of somebody's account that's in equities. Well, if we go into next year without rebalancing anything, getting back to that proper allocation of, in this example, 70%, now we have, let's call it 10 to 15% more risk in a customer's account than they otherwise would need to have. So I'm going to take the profits away from the market, move it into something else that has not participated in this rally, so we can still give ourselves a chance of outperforming without getting out of the sectors that likely will continue to do well if I'm right about the path of inflation, which would be technology and industrials. So this is how you can take control over that allocation and take control over some performance for yourself, your family, and whatever the reason is that you're investing. So I would highly encourage that. You also have to consider taxes, right? So we're getting close to the end of this year. So if you're thinking about rebalancing and you got a trust account or a joint account, maybe consider doing some of that rebalance before the end of this year, and then do the rest next year. Kind of split up the tax liability if you don't have losses to offset gains with. We don't have a lot of losses this year to offset gains with. So that's something that we're also thinking about for customers. And this would be the time of the year where you might want to think about getting your IRA contributions in. Technically speaking, you have up until April to do that. But if you're going to do something like a Roth conversion, that would be something that you would want to handle before the end of the year. There's a lot of reasons for wanting to do a Roth conversion. We can maybe spend some more time on that in a different podcast a little bit later this year, as we talk through tax planning and estate planning, which is generally the big topics, right around the end of a year going into a tax season. So take advantage of that. And then for those that have required minimum distributions, if you're 73 or older with an IRA or 401k, or maybe you have an inherited IRA from somebody who passed that was already taking their required minimum distributions, I would highly encourage you to go about getting that done sooner than later, because the folks that we spoke with, so we custody all client accounts at Charles Schwab. Schwab bought TD Ameritrade, so they're dealing with bringing on 7+ million accounts and advisors and customers, and they also have to process all of that paperwork in addition to all of the tax paperwork, things like required minimum distributions. So if what we've been told, if that's not in the system by early December, like December 1st, there's not a guarantee that they'll even be able to get to processing your required minimum distribution request before the end of the year. And the issue with that is if you do not take out that distribution before the end of December, the IRS will make you take out that amount of money next year, and they'll tack on an additional 50% penalty of whatever amount you were supposed to take out. So don't do that. You do not want that. So I highly encourage all those to jump on that right away. This has been a jam-packed show today, Ez. We covered a lot of stuff. It was
all gas, baby.
Sports, travel, holiday movies, holiday season, a whole bunch of economic data, some historical data on top of that.
Basic financial planning.
Gave you some little bit of tidbits on basic financial planning at the end of the year here. I don't know what else to give you guys. I'm out of stuff. So I think we've covered it all. This has been a lot of fun. Don't forget to check us out, shepherdwm.com. We post all of the newsletters that we've sent out to customers there. They're available for everyone that wants to take a look at that. We post all of the YouTube videos. All the audio from the podcast is also right on our website, shepherdwm.com. And if you like the show, let us know about it. Give us a thumbs up. Hit the notification button. That way when we post these things on YouTube, you're aware. And of course, we love your questions. So if you got some significant questions as it relates to year-end rebalancing or taxes or estate planning, or just general thoughts about 2024 and election year, we'd love to hear about it. It could be something that we want to talk about and share with you. You can text me directly, 513-630-2664. Or if you go to the website, you can drop us an email. All the contact information is there. And of course, we're on YouTube. So we're always checking out comments that we're getting from our viewers. So appreciate the opportunity to deliver this podcast today. Hope you guys have a great Thanksgiving, and we'll catch you in a couple weeks. Take care.